I made my first million at 40, my first billion at 75. Know what the difference was between those 35 years. I stopped doing stupid things, you see. Everyone's hunting for the secret formula, the magic stock that goes up 1,000%, the perfect entry point, the insider tip that'll make them rich by Thursday. They're searching in the wrong damn place. There is no secret. There is just a checklist of idiotic mistakes. Avoid them and you win. It is that simple, it is that hard. I've spent 60 years watching brilliant people, engineers, doctors, lawyers, people with IQs that would make Mensa blush, destroy themselves financially. Same mistakes, different decade, same stupidity, different wrapper. They never learn, and neither will you unless you pay attention right now. 7 mistakes. That is all it takes. Make 3 of these, and you are already 10 years behind where you should be. Make all 7, you'll be 60 years old, broke, angry, and blaming everyone but yourself for your failures. Most people don't figure this out until it is too late. The compounding is done. The opportunities have passed. The easy money, and yes, there was easy money if you were patient and disciplined, is sitting in someone else's account. I am giving you the checklist today, right now for free. This is the Munger method. No hype, no hot takes. That'll be wrong in 6 months. No predictions about what the Fed's going to do next Tuesday. Just principles that worked in 1960 and will work in 2060. Let's see which mistakes you are making. Let's go. Wrong approach, completely, utterly, catastrophically wrong. Look, I am not smart enough to make every mistake myself. I don't have the time, I don't have the money, and neither do you. So I read. Obsessively. Not self-help garbage that makes you feel good about your mediocrity. Not success porn that cherry picks the winners and ignores survivorship bias. Failure stories. I studied every major stock market crash, every corporate fraud that bilked investors, every bankruptcy that wiped out generational wealth. Why? Because the patterns repeat. The warning signs flash in bright neon, and people still walk right into the disaster. You think you are different? You think when the next bubble inflates, and it will inflate, they always do, you'll be the genius who sells at the top. Number, you won't. History says you won't. Statistics say you won't. Human psychology says you won't, unless you study what happened to the idiots who didn't. The South Sea bubble happened in 1720. 300 years ago, people mortgaged their homes to buy shares in a company that had no business plan beyond trade with South America somehow. Isaac Newton, the man who invented calculus and discovered gravity, lost a fortune in that bubble. He said afterward, "I can calculate the motion of heavenly bodies, but not the madness of people." And people today fall for the exact same scam. Different name, same stupidity, same greed masquerading as genius, same belief that this time is different. It is never different. Tulip mania, railway mania, the dot-com bubble, the housing bubble, the crypto bubble, same pattern every single time. Mass delusion dressed up in new technology. This changes everything. They say, no, it doesn't. Human nature doesn't change. I studied the Great Depression like it was my doctoral thesis. I wasn't even born yet, but I damn well learned what not to do. I read about people who lost everything, not because they were stupid, but because they borrowed money to buy stocks, leverage margin buying on credit when the market crashed in 1929. The margin calls came, brokers demanded cash. People couldn't pay. Their stocks got liquidated at the absolute bottom. Generational wealth evaporated in weeks. So what did I learn? Don't use leverage, ever, if you can't afford to own it outright. You can't afford to own it, period. That is the rule. It saved me in every crash, every panic, every moment when brilliant people were getting destroyed because they got greedy and borrowed money. I read every biography I could find, not to be inspired by their success. I don't need a pep talk to catalog their mistakes. Andrew Carnegie made mistakes that cost him millions. John D. Rockefeller made mistakes. Even Benjamin Franklin, one of the wisest men who ever lived, screwed up investments. He bought into some ridiculous scheme that went bust. But here is the beautiful part. They documented their failures. They wrote it down. All I had to do was pay attention. I compressed their lifetimes of painful lessons into a few years of reading. Now, why is this so hard for brilliant people to understand? Here is what you do instead. You lose money in crypto. You act shocked, like you are the first person to fall for a get-rich-quick scheme. You buy a stock at the top because everyone's talking about it. It crashes. You are surprised. But it happened in 2000 and 2008 and 1987 and 1929. The information was sitting there, thousands of books, documentaries, case studies, academic papers. You just didn't read them because you were too busy watching videos about the top 10 stocks to buy now, with the thumbnail showing someone pointing at a chart and making a surprised face. Learning from other people's mistakes isn't just cheaper, it is faster, infinitely faster. I compressed 300 years of market history into a few years of reading. I learned what killed investors in the 1800s, what destroyed them in the 1900s. Every decade, every bubble, every panic, every fraud. I didn't have to live through every crash. I didn't have to lose my money in every scam. I just had to read about the people who did. Here is your homework. Read one investing disaster case study per month, just 1/12 per year. In 5 years, you'll have studied 60 catastrophes you'll never repeat. Read about the dot-com bubble. Pets.com raised $300 million and went bankrupt in 268 days. Webin raised $800 million to deliver groceries and burned through it all. How? Why? What were the warning signs that analysts missed? Read about the 2008 financial crisis. Lehman Brothers, Bear Stearns. How did these titans collapse? What were the red flags? Who saw it coming? And why didn't anyone listen? Read about long-term capital management. Oh, this one's delicious. A hedge fund run by Nobel Prize winners, literal geniuses, PhDs in economics. They built a mathematical model that said their strategy would only lose money once every 1,000 years. Once every millennium. They lost everything in 4 years. How? Why? What did they miss? Read about it. Learn from it. So you never make the same arrogant assumptions about risk models and mathematical certainty. Read about Enron. Not just they committed fraud. How did they commit fraud? What accounting tricks did they use? Why did the auditors miss it? Why did supposedly sophisticated analysts recommend the stock all the way down to bankruptcy? Read about the Tesla shorts who lost billions betting against Elon Musk. What did they get wrong? What fundamental analysis did they miss? Read about Bill Ackman losing $4 billion on Valiant Pharmaceuticals, one of the smartest investors alive. What did he miss? Each one of these stories saves you from making that mistake yourself. Boring, absolutely. But losing your money is infinitely more boring. Trust me, this one drives me absolutely insane. I have a simple rule. If I don't understand it, I don't buy it. Period. End of story. No exceptions, no special circumstances, no but this time might be different. Sounds obvious, right? Common sense? Then explain to me why you bought crypto in 2021. Can you explain how blockchain works? Not parrot back what you heard on a podcast. Actually explain it, the way you'd explain it to your grandmother. Can you proof of work versus proof of stake? Can you explain why Bitcoin has intrinsic value beyond everyone? Agrees it does. Number you can't. I know you can't because I asked you to. And you either skipped over this question or you are currently realizing you don't actually know. You weren't investing. You were gambling, and now you are angry that you lost. Here is what kills me about human psychology. You'll spend an hour researching a $50 toaster on Amazon, reading reviews, comparing features, checking if it has a bagel setting, looking at the wattage, verifying the warranty, but you'll throw $10,000 into a stock because some stranger on Reddit said diamond hands to the moon and posted 3 rocket emojis. Makes perfect sense. No wonder you are not rich. I've passed on thousands of investments. Huge winners, companies that went up 50 times, 100 times, 500 times, and I slept like a baby every single night. Why? Because I didn't understand them, and I'd rather miss a winner than lose money on something I don't comprehend. That is the deal. You can't win them all. You are not supposed to win them all, but you can avoid losing on stupid things. That is completely within your control. I passed on tech stocks in the 1990s, didn't understand them. Everyone said I was an idiot. You don't understand the internet, old man. This is the new paradigm. Everything's going to change. You are going to miss out on the greatest wealth creation in history. Maybe, but I also didn't lose money when they all crashed to zero. When the paradigm shifted back to reality and companies that never made a profit stopped being worth billions of dollars. I passed on Amazon early on. Jeff Bezos was losing hundreds of millions every quarter. The company was hemorrhaging cash. Analysts were calling him a genius while his financials looked like a disaster. I didn't get it, did I miss out? Sure. Amazon went up something like 100,000%. Oops, did I lose money? Number. And that is the entire point. When you only invest in things you understand, you avoid 90% of disasters. You'll miss some winners, that is fine. You'll never become a billionaire from every single opportunity. But you'll also never lose everything on some fraud or bubble you didn't see coming, because you were too greedy or too stupid to admit you didn't understand it. I never bought Enron, never touched WorldCom, never invested in mortgage-backed securities before 2008. Why? Either I didn't understand them, or I did understand them, and realized they were garbage disguised as sophisticated financial products. Either way, I kept my money. Meanwhile, brilliant people, and I am talking about PhDs, hedge fund managers, professional investors with CFAs and decades of experience. They lost billions on stuff they thought they understood but didn't. They got greedy. They wanted to look smart at cocktail parties. So they bought complex derivatives and structured products and leveraged instruments with names that required 3 acronyms to explain. And they got completely wiped out. Here is the test. Can you explain your investment to a 10-year-old? I own part of a company that sells soda. People like soda. They buy it every day. The company makes money selling soda. They give some of that money to me. That is Coca-Cola, simple, understandable. Been around since 1886. Still selling sugar water, still making money. A 10-year-old gets it. Now try explaining this. I own a synthetic collateralized debt obligation that leverages proof of state consensus mechanisms to yield farm governance tokens in a decentralized autonomous organization. What the hell does that even mean? If you need 15 minutes and a whiteboard to explain your investment, you don't understand it. You are just repeating words you heard on YouTube. Here is another test. Can you explain how it makes money? Not why the price might go up. That is not investing, that is speculation. That is hoping some bigger fool will buy it from you later at a higher price. How does the business generate? Where does the profit come from? If you can't answer that in one clear sentence, you're gambling. And you should know the house always wins. So here's what you do right now. Go through every investment you own. Every stock, every fund, every crypto token, every space, every piece of your portfolio. Ask yourself one simple question. How does this make money? If you can't give a simple, clear answer that a child would understand, sell it today, right? Now, before you learn an expensive lesson that I am trying to save you from. You want to get rich by Thursday. Not happening, never happening. Look, I built my wealth over 60 years. Not 6 months, not 6 years, 60 years. And people constantly ask me, what is the secret to getting rich quick? There isn't one. That is the whole secret. There is no shortcut, no hack, no loophole, no special insider knowledge, just time and compound interest doing their inexorable work. The big money isn't in the buying. It is not in the selling. It is not in timing the market perfectly or finding the... It is in the sitting, the waiting, the doing nothing. But you can't sit still, can you? You can't do nothing. It kills you. It makes you feel like you are not working hard enough, not being smart enough, not taking advantage of opportunities. You see someone make 200% on a meme stock in 3 weeks, and you panic. I am missing out. Everyone's getting rich, but me, I need to take action. So you start trading, day trading, swing trading, options, crypto, chasing every hot tip on Twitter, Reddit, TikTok, wherever the financial illiterates are congregating this week. And 5 years later, you've gone absolutely nowhere. Actually, worse than nowhere, because you paid fees and taxes on every single stupid trade. Meanwhile, that boring guy who bought an index fund 5 years ago and forgot about it, he is up 60%, 70%, maybe 80%. He doubled his money. He is sleeping well, not checking his phone every 5 minutes, not having a panic attack, not arguing with strangers on the internet about why his stock is going to moon. He just did nothing and won. Here is the math you don't want to hear. 20% per year doesn't sound exciting, does it? It sounds boring, slow, pedestrian. Your buddy made 500% on GameStop in a week. Why would you settle for 20% a year? Because 20% per year for 60 years turns $10,000 into $500 million. That is not a typo. That is not an error. That is compound interest. That is what Einstein called the eighth wonder of the world. Not because it is flashy, because it works. But you don't want to wait 60 years. You want to be a millionaire by 30, a multi-millionaire by 40. You want it now. So you take risk, big risk, stupid risk. You use leverage. You trade options. You go all in on speculative garbage that has a good story but no earnings. And you know what happens? You lose it all, or you make some money, get cocky, and lose it all on the next trade. You don't need home runs. You don't need to find the next Tesla or Bitcoin or whatever. You need to avoid strikeouts, hit singles, get on base, don't swing at bad pitches. That is it. That is the whole game. But your ego won't let you play it that way. You want to brag at parties. I made 500% this year. You want to screenshot your portfolio gains and post them on social media for validation from strangers. You don't want to say, I am slowly compounding wealth over decades by investing in boring companies and index funds. That is not impressive. Nobody's going to give you likes for that, but it works. And your way doesn't reality check. If you've been investing for 5 years and you are not beating a simple S&P 500 index fund, you are not an investor. You are a gambler with a losing record. The S&P 500 averages about 10% per year over the long term. Just sitting there doing nothing. No genius required. No special knowledge. No hot tips, no Discord groups charging $500 a month for exclusive alpha. If you are doing worse than that after all, your research, all your trading, all your stress, all your subscriptions to premium services and stock, picking newsletters, you are literally better. Just buy the index fund, set it and forget it. Go live your life. Play with your kids, learn a skill, read a book. Check back in 30 years. You'll be rich. Not exciting, but correct. Here is the really brutal part that Wall Street doesn't want you to know. 90% of active traders don't beat the index over 10 years. Those aren't good odds. You are not special. You are not the exception. You are not smarter than the market. You are part of the 90% losing to a robot that costs $3 a year in fees. Sit on your ass, invest. That is it. That is my secret. It is boring. It works. This is where Wall Street really screws you over. They love telling you to diversify. Don't put all your eggs in one basket. Spread your risk. Protect yourself. Sounds smart, right, prudent, responsible. So you do what they say. You buy 50 stocks. You buy international funds, emerging markets, bonds and REITs and commodities and crypto and gold and silver and platinum. You own everything. Congratulations. You've achieved perfect diversification and you own nothing. Here is what I actually said about this, and you should tattoo it on your arm. Diversification is protection against ignorance. It makes very little sense for those who know what they're doing. Read that again. Let it sink in. Diversification is for people who don't know what they're doing. If you actually understand investing, if you've done the work, studied the businesses, understand the competitive dynamics, you don't need 50 positions, you need 6, maybe 10 if you are feeling cautious. At one point, 90% of my net worth was concentrated in one company, Berkshire Hathaway. Was I crazy? Was I reckless? Was I taking unnecessary risk? I understood that business inside and out. I knew how it made money. I knew the people running it. I knew Warren for 50 years. I knew his temperament, his judgment, his discipline. I wasn't diversified. I was concentrated in what I knew, in what I understood deeply. And it worked out pretty well. Last time I checked, I died a billionaire. Now look, I am not telling you to put 90% of your money in one stock. Unless you are me or Warren Buffett, you probably shouldn't. But here is the problem with over-diversification that nobody tells you. When you own 50 stocks, you basically own the entire market, which means you get market returns. About 10% per year, fine, acceptable. But here is the catch. You can't possibly understand 50 businesses. You don't have time to read 50 annual reports, follow 50 management teams, understand 50 different industries with different competitive dynamics, regulatory environments, technological disruptions. So you are not really investing. You are building a do-it-yourself index fund with more work, higher fees, more taxes, and probably worse returns because you'll make mistakes picking those 50 stocks. You'd literally be better off just buying an actual index fund and saving yourself the headache. Here is the smarter approach. Own 8 to 12 businesses you actually understand. Not 50 names you picked from a stock screener because they had good P/E ratios. Not everything under the sun because you are scared and don't know what else to do. A concentrated portfolio of businesses you've actually researched, companies you understand, industries you follow, competitive advantages you can articulate. I said this once, and it is still true. If you can identify 6 wonderful businesses in your lifetime, that is all the diversification you need. 6, not 60. 6 truly great companies that you understand, that have durable competitive advantages, that are run by honest and competent people. Buy them, hold them, get rich slowly. And if you don't deeply understand individual businesses, If you don't want to read annual reports and follow earnings calls and study competitive dynamics, then just own an index fund seriously. That is not a failure. That is self-awareness. That is actually smart. Most people would be way better off in an index fund than pretending they're stock pickers. There is no shame in it. The shame is in owning 50 stocks you don't understand, underperforming the market, paying unnecessary fees and taxes, and wasting your time. That is shameful action step. If you own more than 20 individual stocks right now, you are over-diversified. Cut it down. Keep only the ones you truly understand and believe in. If you can't explain in one sentence why you own it and how it makes money, sell it today. And if that means you end up with just 5 stocks or an index fund, good. You've just improved your portfolio and saved yourself years of mediocre returns. This one's boring. I know nobody wants to talk about expense ratios and tax efficiency and fee structures. It is not sexy. It is not exciting. It doesn't make for good conversation at dinner parties, but it is costing you tens of thousands of dollars, maybe hundreds of thousands, maybe millions over a lifetime. Pay attention. This might be the most important thing I tell you today. Let me show you some math. Real math, the kind that should make you physically ill. Scenario 1. You invest $10,000 per year for 30 years. You use a low-cost index fund with a 0.04% expense ratio, basically free. You buy and hold, don't touch it, don't trade. At 10% annual returns, you end up with about $1.8 million. Nice, that is a good retirement. That is security. That is freedom. Scenario 2. You use an actively managed mutual fund. 1% annual fee. That doesn't sound like much, right? Just 1%. 1 measly percent. Barely noticeable. Some $10,000 per year. Some 10% returns before fees. But after fees, you actually get 9% per year. You end up with about $1.5 million. The difference, $300,000 gone, vanished, vaporized into your fund manager's pocket for the privilege of underperforming the index. That is not a typo. A 1% fee cost you $300,000 over 30 years. For nothing. Actually, worse than nothing, because most actively managed funds don't even beat the index. So you are paying more to get less. Brilliant strategy. And that is just expense ratios. That is just the annual management fee. Now, add fee trading commissions. If you are constantly buying and selling fee bid, ask spreads fee capital, gains taxes every time you sell something for a profit, fee short-term capital gains. If you held less than a year, taxed at your ordinary income rate, which could be 37% fee long-term capital gains, 15 to 20%. Still significant. Most active traders are giving away 30 to 40% of their gains to fees and taxes. Then they wonder why they're not building wealth. I am up 50% on my trades this year. Great, after taxes and fees, you worked your ass off, stressed for 12 months, and barely beat the index fund that required zero effort. Warren and I obsessed over this for decades. We held stocks for 30, 40, 50 years to avoid paying capital gains taxes. Why sell? The moment you sell, you pay taxes. You lose 20% right off the top. Now you have to find another investment that is 20% better just to break even. That is a high bar, usually an impossible bar. Stupid, just hold it. Berkshire Hathaway doesn't even pay dividends. You know why? Because dividends are taxed immediately. The government takes their cut before you can reinvest it. We'd rather keep the cash inside the company, reinvest it in more businesses, and let it compound tax-free for decades. That is how you build generational wealth, not by paying taxes every year on dividends and capital gains. But what do? You trade constantly. You sell winners too early because you are scared of losing your gains. You hold losers too long because you are too stubborn to admit you were wrong. Every trade equals fees. Every short-term sale equals higher taxes. You are working against yourself. You are bleeding money and you don't even realize it. Action step. Calculate how much you paid in fees and taxes last year. Actually do this exercise. Don't skip it. Go to your brokerage account. Look at your 1099 tax form. Add up your capital gains taxes. Add up your trading commissions. Add up your expense ratios if you are in mutual funds or ETFs. Add it all up. If that number is more than 1% of your portfolio value, you are trading too much. You are paying too much. Cut it out. Switch to low-cost index funds. Stop trading. Hold for the long term. I am serious. This might be the single most important piece of advice I can give you. Minimize fees and taxes. It is not sexy. It is not exciting. But it might be worth an extra $500,000 to you over your lifetime. Pay attention. This is the big one. This is what destroys most people. This is why smart people with good intentions, high IQs, Ivy League degrees, and sophisticated strategies end up broke. Your biggest enemy isn't the stock market. It is not the economy. It is not China or inflation or interest rates or Jerome Powell or whoever's running the Fed this decade. It is you, your emotions, your fear, your greed, your panic, your FOMO. Your need to do something, anything, when the smart move is to do nothing. When the market crashes, you panic and sell everything. When the market's booming, you FOMO and buy at the top. You do the exact opposite of what you should do. Buy low, sell high. Great advice. Everyone knows it, nobody does it. You know what people actually do? Buy high, when everyone's excited and everything feels safe and profitable. Sell low when everyone's panicking and it feels like the world is ending. Every single time. Like clockwork, like lemmings walking off a cliff. Let me give you some real examples. March 2020, COVID hits. Nobody knows what is happening. Market crashes. And P500 drops 34% in 1 month. Fastest crash in history, panic everywhere. News channels showing death counts 24 divided by 7. Experts saying this could last years. Everyone's terrified. What did most people? Sold everything. It is going to zero. This is the end. The next Great Depression, cash is king. Get out now before you lose everything. What did we do at Berkshire? Nothing. We sat there, actually. We bought more. The market was on sale. Great businesses trading at huge discounts. Why would we sell? And what happened? Market fully recovered by August. Hit all-time highs by the end of the year. Everyone who panicked and sold at the bottom, they locked in their losses permanently. Then they were too scared to buy back in. They missed the entire recovery, the greatest buying opportunity in a decade, and they did the opposite of what they should have done. Then 2021 comes. Market's booming. Everything's going up. Crypto's going insane. Bitcoin hit $60,000. Dogecoin, a literal joke coin created to mock cryptocurrency, hit 70 cents and had a $90 billion market cap. Meme stocks, GameStop, AimStop, AMC, everyone's making money. Or so it seems. This time is different. New paradigm, Fed money printer, go borrow. What did most people do? Jumped in with both feet. I am missing out. Everyone's getting rich, but me. I need to get in. Now before it is too late. FOMO is a hell of a drug. What did we do at Berkshire? Nothing. We were sitting on $150 billion in cash, just sitting there doing nothing. People called us idiots. Buffett and Munger are too old. They don't get it. They don't understand crypto. They don't understand memes. They don't understand this new world. Boomers, dinosaurs. This time is different. We heard it all. We ignored it all. And what happened 2022? Market crashes, crypto crashes. Bitcoin dropped 70%. All those meme stocks gave back everything. NFTs became worthless JPEGs that nobody wanted. All those diamond hands turned into paper. All those people who bought at the top in 2021, most of them are still hoping to break even. Meanwhile, we had $150 billion in cash, ready to deploy when everything got cheap again. Here is the pattern you need to understand. When you feel like you should sell, when your gut is screaming at you to get out, when you are checking your portfolio every hour, when you can't sleep at night, that is usually when you should hold or buy. When you feel like you need to buy. When everyone around you is making money, when you are missing out. When it feels like easy money and you'd be an idiot not to get in. That is usually when you should wait or sell. Your emotions are designed for short-term survival in the African savannah. Run from the lion. Fight the enemy. Don't eat the poisonous berries. Greet for keeping you alive in the jungle. Terrible for building long-term wealth. Your short-term panic instincts will destroy your long-term financial future. Action step: write down your investment rules right now. Not during the next crash, not during the next bubble. Right now, when you are calm and rational, write them down. Faye, I will not sell during a market crash unless I actually need the money for living expenses. Faye, I will not chase hot stocks just because they're going up. Faye, I will not check my portfolio more than once a month. Faye, I will not make investment decisions based on fear or greed. Whatever your rules are, write them down, print them out, put them somewhere. You'll see them every day. And when the next crash comes, and it will come, and your emotions are screaming at you to do something stupid, read your rules, follow them, not your feelings. Your feelings are trying to kill your financial future. This is the killer. This is the one that destroys more wealth than all the others combined. This is the tragedy that breaks my heart every time I see it. You quit too early. You give up right before it works. Most people try investing for 2 years. 3 years, maybe 5, if they're unusually persistent. They don't get rich. They get frustrated. They get bored. They quit. They say, investing doesn't work. The game is rigged. Only the rich get richer. The little guy can't win. The system's corrupt. And they go back to buying lottery tickets and complaining about inequality on the internet. Here is what they don't understand. Wealth compounds slowly at first. Very slowly, painfully slowly. For the first 10 years, it feels like nothing's happening. You are putting in money every month. The numbers go up a little, then down, then up a little more. It is boring. It is frustrating. There is no dopamine hit, no excitement. You look at your account after 5 years of discipline and saving and investing, and you think, that is it. After 5 years of sacrifice, that is all I have. This is pointless. I get it. I understand the frustration. I've been there. But here is what happens if you keep going. Year 15, year 20, year 25, year 30. Suddenly, the numbers start moving fast, really fast, because you are not just earning returns on your contributions anymore. You are earning returns on your returns. You are earning returns on the returns of your returns. That is compound interest, and it is exponential, not linear. The first $100,000 takes forever. Feels impossible. You are grinding, saving, investing, and it takes years, sometimes a decade, to hit that milestone. But the second $100,000 happens way faster, the third even faster. By the time you get to your fifth or sixth 100,000, they're coming every year or two. That is the magic of compounding. That is what you are working toward, but you only get there if you don't quit. I didn't make serious money until I was in my 50s. Didn't make my first billion until my 70s. That is 30, 40, 50 years of doing the same boring things over and over. Buying good businesses, holding them, reinvesting dividends, letting it compound, not selling during crashes, not chasing bubbles, just being patient and disciplined for decades. Most people don't have that kind of patience. They want results now, and when they don't get them, they quit. They try stocks for a few years. Doesn't make them rich. They switch to real estate. That doesn't make them rich fast enough. They try crypto. That blows up. They try options trading, lose money, day trading, lose more money. They spend their entire lives jumping from strategy to strategy, never sticking with anything long enough for it to actually work. Here is the truth. Nobody wants to hear. The stock market has returned about 10% per year for the last 100 years. Through world wars, through the Great Depression, through recessions and crashes and bubbles and panics and everything else. 10% per year on average. That means if you invest consistently and don't do anything stupid for 30 years, you will build significant wealth. Not maybe, not probably, you will. It is math. It is inevitable. But you'll be tempted to quit. Oh, you'll be so tempted. In year 3, when there is a crash and you are down 30%, and everyone's saying it is the end of the world. In year 7, when your buddy made 500% on some cryptocurrency and you are only up 80%, and you feel like an idiot. In year 12, when it feels like you are running on a treadmill going nowhere, and you are wondering if this is even worth it. That is when most people quit right before the exponential growth phase kicks in, right before all those years of patience start paying off big time. Don't be that person. Don't quit. You've already done the hard part. You've already suffered through the slow years, the boring years, the years where it feels like nothing's happening. If you quit now, all that was for nothing. But if you keep going, if you give it another 10, 20, 30 years, you'll be in the top 5% of wealth in this country, guaranteed. So here is my last piece of advice. Then I am done. Then you pick a strategy, index funds, dividend stocks, value investing, whatever, something boring and proven. Something that has worked for decades, not something some 23 year old invented last week on TikTok. Then stick with it for 30 years minimum, not 3 years, 30 years. Don't quit when it is hard. Don't quit when it is boring. Don't quit when your friends are making more money doing something else. Don't switch strategies every 2 years chasing the next hot thing. Just keep going, keep contributing, keep reinvesting through crashes, through booms, through boredom. Through FOMO, through fear. Just keep going. That is it. That is the whole game. Avoid these 7 mistakes. Be patient, be disciplined, don't quit. You won't get rich in 5 years. Probably not in 10 either. But in 30 years, you'll be wealthier than 95% of people in this country. And you'll have done it without stress, without gambling, without getting lucky. Just by being patient and not being stupid. Now, if you made it this far, you are serious about this. Most people already clicked away. They're looking for top 5 stocks to 100 times in 2024 or whatever garbage is trending. They want the lottery ticket, not the proven path. Good, less competition for you. More opportunities for patient people who actually understand how this works. Hit that subscribe button if you want more of this. No hype. No hot takes, that'll be wrong in 6 months. No predictions about what the market will do next Tuesday. Just timeless principles that worked 50 years ago and will still work 50 years from now. Principles that made me a billionaire. Principles that will work for you if you follow them. That is what this channel is about. That is what I am here for. I am out. Go do boring things that make you rich.